Right now, the top-line numbers for major financial institutions look incredibly strong. JPMorgan is pulling in over $50 billion in revenue. Citigroup is reporting its best quarter in a decade, and BlackRock is seeing massive client inflows. From the perspective of JPMorgan CEO Dimon, the message is clear. Consumers are still earning and spending, and the broader economy appears highly resilient. BlackRock's Fink echoes this sentiment, describing the start of the year as one of the strongest in their history. Financial institutions arrive at these confident conclusions by looking backward. They underwrite loans by measuring loan-to-value ratios, checking credit scores, and evaluating past payment histories to predict future behavior. These booming numbers are merely symptoms. Banks are currently blind to the actual cause of economic health because they fail to measure the living-to-income gap, the precise dollar distance between what a household earns and what it actually costs that household to survive. To understand this blind spot, consider how these three separate columns represent the payment ledgers for a bank, a landlord, and a utility company. Every institution operates in complete isolation. The bank has no visibility into whether a customer is paying their power bill, and the utility company has no idea if that person is making rent. The landlord and utility columns flash red as a household skips meals, misses power payments, and delays rent. Yet, as long as they prioritize their mortgage, the bank's ledger remains perfectly stable. When the bank finally registers a late mortgage payment on its isolated ledger, the household has already been living below the survival threshold for months. An absolute data vacuum prevents any single institution from seeing the unified financial reality of a household, allowing the system to fragment long before the bank ever notices a problem. Because banks cannot see those widening gaps across other ledgers, they take the limited data they do have, like a steady mortgage payment, and mistake it for genuine economic strength. These false positive readings are phantom signals. They create a dangerous illusion of stability in housing markets or employment sectors that are actually hollowed out from within. Building on a phantom signal eventually leads to a synchronized collapse. A structure that looks solid on the surface can fail instantly when its unseen, fragmented foundation crumbles all at once. Today's record banking profits are the temporary echo of a fragmenting system, building a massive bubble directly on top of a systemic blind spot. Preventing this collapse requires a coordination layer, a protocol that can see across different ledgers without violating individual privacy. Every household is a point of origin, a glowing node. The protocol queries their data, making individual surveillance impossible. These nodes cluster into calibration points, revealing community distress patterns. These then roll up into calibration hubs, aligning with municipal grids. This architecture allows a bank to see when an entire community is approaching the survival threshold, eliminating the blind spot without ever spying on a single person. Once the protocol detects a widening gap at a calibration point, it transitions from observation to intervention by issuing algorithmic dividends. The algorithm identifies the critical node where a single payment prevents a cascade of defaults across the bank, landlord, and utility simultaneously. Because one dividend heals every ledger it touches, it prevents enough losses to generate a 36-to-1 return. This targeted mathematical mechanism heals multiple intersecting ledgers simultaneously, protecting the economic ecosystem through algorithmic precision rather than charity. Closing these circuits unlocks the $590 trillion in global capital currently trapped in bad debt, deferred maintenance, and workforce turnover. To survive, banks must evolve from siloed debt collectors into economic coordinators that collaborate with employers, landlords, and utilities. The record revenue jumps celebrated by Wall Street today are real, but they are built entirely on a hidden widening gap. Financial institutions must adopt this coordination layer to heal the hub, or watch the phantom signals fade and the foundation completely collapse.